Let's bring in Eric Nuttall, who, of course, we know a prolific energy investor in this country, who's a partner and senior portfolio manager at Ninepoint Partners. Eric, what do you think of the move that we're seeing in crude? Are you getting a little nervous about your energy positions?
Hey, good morning, Amber. No, I don't think the move today is surprising to anybody that was following the events over the weekend, given the run-up and expectations of the possibility of a much more serious strike by Israel on Iranian oil infrastructure, actually impacting potentially crude flows. I think the market views it as a very meek response, perhaps bowing to U.S. pressure 8 days ahead of a U.S. election, where the Biden administration, Kamala Harris, couldn't afford to have a major crude spike so close to the election. So I think what we're seeing is the complete removal of any political risk premium that was in the oil price. You're seeing we had a short-term increase in net speculative length over the past week. That's being flushed out. And you also have banks having to square off the risk exposure given the hedging that they've been doing on behalf of the producers. So I think this is just, you get a financial washout and we'll recover over the next couple of days.
Recover to where, and what's that predicated on?
Well, it's predicated on a few things. So we've eliminated one of three key uncertainties. At least that's the market's perception. The market now believes this is a de-escalatory strike when we can now remove all geopolitical premium from the oil price. We now have the U.S. election and a key OPEC meeting on December 1st to get through. So oil price is going to be dependent on those two things. We continue to view a likely Trump victory as bullish crude oil. We have Iranian oil exports at multi-month highs, as high as 1.7 to 1.8 million barrels per day. We expect Trump to be very, very hawkish on enforcing their own sanctions on those barrels. We think the drill, baby, drill mantra has absolutely no teeth. There's nothing a U.S. president can really do to get domestic price going up. And now with the faceplant in the price of oil, we think it is less likely that OPEC will go ahead with returning barrels beginning in December, this gradual unwinding of their voluntary cuts. And so we're in a market now where everybody's bearish. You've got, Citibank, the perennial bear, is calling for $60 oil. But let's reflect on things. Everyone knows that Chinese demand is weak. That's very, very well known, and I think that's reflected in the price. What we have is global oil inventories near their lowest levels in history on a seasonal adjusted basis. Demand is okay. It's not shooting the lights out. But as we look to next year, we are now in budget planning for U.S. shale companies, for Canadian companies for that matter. And with a strip well below what I think they need to justify drilling, I think you're going to see even tamer spending plans for 2025. We've seen that being reflected in guidance coming out from global service companies over the past week. And so we think we're not ultra bullish now. We're not calling for an $85, $90 oil. We think 70 to 80 is a likely bend, but the market today is just far too bearish. And there's no reason to be panicking right now. What you're seeing today in the oil price is just a financial flush out, and we'll get past this.
Your catchphrase on the street is, we remain bullish on energy stocks. And so my question is, what would it take for you to change that outlook?
Sure, we would need the fundamentals to go against us. And so we would need to see global inventories meaningfully rising. We would have to see demand weakening significantly more. We would have to see non-OPEC supply rallying, shale exceeding expectations. None of those remain our base case. And so, if we just let's reflect on where we were last week at $70 oil. You can buy into companies today with no debt or very little levels of debt, generating free cash flow levels of 14 to 16%, aggressively buying back their stocks, sitting on decades worth of inventory. We see the prospect of Chinese demand very slowly and from a low base, but gradually improving. We think people are far too optimistic on supply. So we just don't see balances being nearly as weak next year as people believe. If everybody wants to be bearish and you're calling for $60 oil, you're ignoring two things. One, that is demand stimulative. And secondly, that is wreaking havoc on the ability to grow supply from short cycle Canada and US next year. So, we're not calling again for ultra high levels. Canadian energy stocks don't need ultra high levels. At $70 oil, every day is a good day for Canadian companies because they're still generating adequate levels of free cash flow to be able to meaningfully buy back their stock and drive an inevitable re-rating.
You mentioned that a Trump presidency, which is what the financial markets are betting on, would be positive for oil. I'm wondering, what if the financial markets are incorrect. Do you think
Sure.
that oil is vulnerable here and that there would be, a trade back into renewables, which have been crushed recently?
Yeah, they've been crushed because they're the worst businesses in the world with low to no margins and no barriers to entry. Terrible businesses. If we see under a Kamala Harris victory, it's status quo for oil. You've got an administration which, similar to our own current administration, not the biggest champions of oil and gas, energy ignorant. That's status quo. And under status quo, what we see is almost no growth coming from U.S. shale next year. Under a Trump presidency, again, no impact on domestic policy at all. And I get that from talking directly with oil CEOs. It's a bit of a joke to think, this drill baby drill. It's a huge red herring. But where I think the market is getting it wrong is you will have a gentleman who elected president who thinks that the Iranians were behind an assassination attempt. He is highly likely to be hawkish on enforcing their own sanctions. They have sanctions in place that they're willfully being blind to because they don't want a high oil price / gasoline price heading into election in 8 days. So we think this chronic bearishness is going to alleviate a little, and we think that Trump will have more than enough cover to enforce their very own rules. And what that will mean is, in time, Saudi and the UAE can step up. They can bring barrels back on, replace lost Iranian barrels, but that'll lower OPEC's spare capacity, which is a very bullish signal for the oil price. And so, we think just the market's far too bearish right now. And if people are watching and you're seeing oil getting crushed and whatnot, you have to appreciate this is the financial flow. You've got risk off, you've got people that went long into the weekend expecting a strike. It wasn't as aggressive as some people thought it may have been. You have banks having to reduce exposure. Give it a day, give it 2 days. I think we'll recover from this pretty quickly. Let's
do some name dropping before I let you go. High conviction ideas. Are you skewing towards quality? Do you want to be in the torquier names?
Yeah, so we're sitting on 19% cash right now, and I would expect that in 20 minutes time, we're going to be going shopping. Names are independent down 4%. What I would say is you want to stick in Canada. You want to stick in oil. Balance sheets, generally speaking, are very strong, but you can buy businesses with no debt. You want to buy companies that are pursuing no growth next year and instead are maximizing their free cash flow. And every single day in the market, every single week, every single month, just absorbing stocks which today are trading at a misprice. So those are the general attributes. If I mention a name, I can't buy it in 20 minutes time. But from the larger companies that have committed 100% returns to free cash flow, very strong balance sheets, low to no growth, those are generally the attributes that I'd be focusing on.